One of the audit that can be run in one of the supplier qualification phases is the economic and financial audit. And I mean, I would like to spend some some time on that because it is very important, and it is something that you can usually be required to look at or to analyze, especially if you are if you work in purchasing at the first experience, because this is something just required to analyze documents, and let's say you don't have to interact with anyone, so you don't have there is no risk to make mess or to do something which is compromising that, like supplier relationship and so on. In order to assess, to audit supplier from an economic, financial, and reputational and risky perspective, you can do two stuff, which can be or complementary or it's like exclusively executed. You can run an analysis by yourself, which is mostly limited to economic and financial analysis, because to make a risk and reputation analysis you need then an external assessor, but you can do the analysis by yourself, so by taking supplier financial statements, so the balance sheet, the income statement, the cash flow statement, and evaluate its financial and economic stability from this document, or you can rely on an external provider which is able to provide you some report where generally speaking all of these three analyses are provided, including the risk and reputation assessment. But again, generally speaking, these are the three aspects that you are interested in when you run let's say in economic, financial, and reputation auditing: profitability analysis, liquidity analysis, and risk and reputation. I will focus on the first two by reviewing some of the accounting principles that can help you in doing a profitability and liquidity analysis, and then we will go by analyzing a real auditor report for the risk and reputation. First of all, balance sheet of a company is made by, the statement of a company are made by different documents. One is the balance sheet, the second one is the income statement, the third one is the cash flow statement. For the purpose of let's say supplier financial and liquidity analysis, we will just limit the attention on the balance sheet and the income statement. Please consider the fact that also the cash flow statement can be relevant to be looked at. Let's start with the balance sheet. The balance sheet is made by two big sections. Assets, which are all the activities, all the properties that are owned by a company, so that are represented by the company. So they are the core of the company and through which the company executes its processes. And they are distinguished between current assets, non-current assets, and assets classified as held for sale and disposal. So non-current assets are all the assets that extend their value besides the current year. So the current accounting year, like property, plant and equipment, investment property, goodwill, other intangible assets, equity investment, other non-current financial assets, and deferred tax. So they are all the assets that are owned by the company today and that the company expects to own also after the current year. Okay? Current assets are instead all the remaining assets of the company, which instead are expected to, let's say, to consume their value in the current year, like inventories, like order work in progress, like short-term financial assets, like cash and cash equivalents, like trade and other receivables. These are all the assets that are owned by the company today, but I don't expect to own them at the end of the year because I should use them to support my operations. Well, instead, assets classified as held for sale and disposal are all the assets that are currently owned by the company, but we already know that they will no more own, not because I will use them for the process, but for running my processes, but because I know that they will be used for being sold to other parties. That's the asset section. The asset section should match what is called the liabilities section. The liabilities section summarizes all the people, all the subjects that have rights on my assets. So how internal and internal people, let's say, have some linkage with my assets. So which are the rights that other people have on properties and on activities that I actually own as a company. In particular, we distinguish between which are shareholders here, which are, let's say, people that own the company. So these are the people that are actually investing in the company, and they are interested that the company is performing very well because their revenue, their profit, and their payback of their investment depends on how the company works. In particular, shareholders have issued capital, so the capital that they have invested to open the company, to make the company running, possible reserve that they have accumulated during the years, and again, if there is a profit or also a loss each year after the income statement, at the end of the income statement, this profit or loss is absorbed by shareholders because they are the representative of the company, they are the main investors. However, we don't just have internal investor. We also have external people like suppliers, like bank, like other companies, like governments, that even if they don't own the company, have made investment in the company directly or indirectly. For example, if a supplier is giving me goods and I'm not paying him immediately, but I'm paying you after 6 months, of course, he doesn't own any part of my company, but he has made an investment in my company. So he knows that he has already given me some goods, but I still have to pay him back. So this means that the supplier owns some rights on my company, which is the right of being paid after a certain amount of time because I'm already consuming some assets in terms of goods that he has given to my company. This is the idea of, let's say, external liabilities. So rights that external people have on my assets and on my company. Also, in this case, we distinguish between non-current liabilities, so rights, so value of rights that external people have on my company, which is not supposed to finish after the current year. So these are bonds, bank debt, long-term bank debt, other financial non-current liability, provision for liability and charges, pension and similar obligation, and deferred tax liabilities are all liabilities that are not supposed that are supposed to be present also after the end of the current year. Non-current liabilities. Next year, these people, like government, like bank, still own some part of their interest in my company, which instead is opposed by what is called current liabilities. Current liabilities instead are all the rights that people are having on my company, but just for this year. So I expect that short-term bonds, short-term bank debts, trade and other payable, other financial current liabilities and current tax liabilities will be over after the end of the year. So in the next, let's say, in the next design of the liability section of the balance sheet, I expect this in this form, like today, not to be present anymore. Finally, also in this case, we have liability directly associated with assets classified as held for sales and disposal groups. So these are liabilities which I already know that will not be present in the next design of the balance sheet liability section, but not because they will be extinguished, but because they will be like passed through other type of ownership, or they will be eliminated in some way, or they will be sold in some other with some other instruments, but they are not classified neither as current or non-current. So these are the two sections of the balance sheet. Should be consolidated, but you should already have seen this in many courses, also at the beginning of this one. Then we have the income statement. This is the income statement. The income statement is then summarizing, let's say, revenues and costs that have interested the companies in the current year. In particular, we have a first part until here that summarize revenues and cost which comes from operational processes. So sales of product and costs coming from product. Okay, so these are the total revenues coming from products sold in the market, and these are all the operating expenses coming from making our production system running to realize this product. Okay, the difference between revenue and revenues from products and operating expenses is named operating profit, yes, operating profit, or operational margin on market activities. So this is just the profit that I have, how much I'm profitable by selling product on the market and let's say consuming resources to sell this product. Which is different from revenues and costs that I experience here, because please remember that a company cannot just gain or lose from operational processes, but also operational activities, but can also gain or lose from financial activities. So here in this part, I summarize the income and the expenses coming from financial investment and from general investment, like in equity accounted investment and so on. So here I have finance income and finance expense, and here I have share of profit of equity accounted investment and other gain or loss from investment. If I sum these two possible sources of revenue and cost from financial activities, I obtain what is called the profit before income taxes, which is the level of profitability of a company, including their ability to be profitable on operating process and operating activities, and its ability to be profitable from financial investment. So if operating process just consider the ability of being profitable in selling product and using resources for realizing the product, by adding this part, I include also the ability of being profitable by, let's say, balancing also other type of activities, in particular financial activities. It is on this profit that governments calculate taxes. Okay. Income taxes are calculated according to the profit before income taxes, so the profit after operating activities and financial activities. By subtracting the income taxes, I obtain finally the net profit, which is the overall profitability of a company, considering the ability of being profitable in operational activities, in financial investment, and after having, let's say, respected, let's say, imposition given by the government. And as you can see, in this case, this is an example where the profit is positive, and as you can see here, the profit is distributed among this is the name of the company, so it is Eni, is an energy company. It's in part distributed by main Eni investors and a part distributed to minor Eni investors. So as you can see, as we are profitable, the rights that my shareholder owns on my company are increased, because the profit, it's something that is redirected to my main investors, which can be direct company investor or minor company investor. This is structure of the income statement. So a structure of revenue and cost, including revenue and cost coming from operational activities, revenue and cost coming from financial activities, the total of income taxes, and the net profit. If it is clear, let's step to the first type of analysis that you can perform when you deal with the balance sheet document, the income statement document. The profitability analysis. Profitability analysis is able to evaluate the level of the profitability of a supplier during time. And you can do that by calculating this type of KPI, key performance indicator. The most common one is called return on equity, which measures how much the supplier is able to generate profit for its shareholders. It is the ratio between the net profit and the equity. The equity is the sum of this. This is shareholder equity. So you take the balance sheet, you go on the liabilities, you see the total of the shareholder equity, you go on the income statement, you see the net profit, and you can calculate the ROE, net profit ratio equity, how much the supplier generates profit for its shareholder, which is different from return on investment, which is how much the supplier is able to generate profit from its operational activities, which is earning before interest and taxes divided total assets, which means operating profit. Operating profit is also known as EBIT, earning before interest and taxes, because again is the earning before interest, so financial activities, and taxes. Okay, you take the operating profit, you take the total assets, so it means the sum of this, and this, and you calculate the return on investment, which measures how much the supplier is able to generate profitability, EBIT, using total asset of the company. Then you have this ratio, which is named debt-equity ratio, which means analyzing how the supplier financially support his activities. So on the liabilities, the supplier structure is more equity-oriented or debt-oriented. You sum the total debt with the total equity, which means going here, this is the total equity, this is the total debt. So they are the all liabilities that are not equity. Okay, they are named debt, so external debt. You divide the two, you have the debt-equity ratio. Then you have the cost of debt. So you can see how much is the cost of debt for the supplier. This is made by, let's say, dividing the overall interest on investment divided by the overall interest of debts, which is here. Here, income from investment, financial income. Finance income is all the interest that the supplier or a company is gaining from financial investment, while financial expenses is all the interest that the company is paying from, let's say, borrowing money from other companies. Like, for example, if you go to a bank, you want a loan, the bank is giving you a loan, but then ask you interest on that loan. Here, you find how much interest a company pays each year, while instead, of course, company can borrow money to other companies or to other institutions. Here you find all the interest that they, let's say, that they have from financial activities in output, not in input. If you make the ratio between the two, you are able to understand how much is the cost of debt. Okay, so if you are able to repay with the interest you gain from investment, the interest you have to pay on debt. Okay, of course, this can be higher or lower than 1, and according to this, you can see if you are more balanced when in paying interest on debts or interest on investments. Then you have the return on sales. Return on sales has a similar meaning of the return on investment, but instead of making the ratio between the earning before interest and taxes with the total assets, you make the ratio between the earning before interest and taxes and the revenues. Take the income statement, operating profit or EBIT, and you make the ratio between the operating profit and the revenues, which means evaluating how much profit you are able to keep on every revenues that you make. So if, for example, the return on sales is 10%, it means that for every dollar that you sell on the market, for every dollar of revenues that you make on the market, 10 cents result as profit. So you remember that revenues, then you need to subtract cost. If the profit is 10%, it means that $1 of revenue results in 10 cents of profit. Finally, you have activity rotation. Activity rotation is evaluating how much supplier activities need to rotate to generate revenue, which is the ratio between revenues and total assets. So again, you take the revenues, you take the total assets, making the ratio between the two, you understand how much time the assets need to be used in order to generate this amount of revenues. If it is 2, if the result is 2, it means that if the result is 2, it means that to generate this kind of this level of revenue, you need to use on average each asset 2 times. Here you find an example of calculation. I mean, I don't go through this because then I will go through this in class, but you see here, you see exactly the value that I use to calculate the indicators here. For example, here you have very huge values. So in this case, it's a particular case because the equity is very low for this type of supplier. And you see that the net profit that you are able to generate, for example, in 2012 and 2014 is higher than the overall amount of equity. So you have 109%, 111%. So this is very high and very also atypical value. So it means that this company is able to generate profit for their shareholders. Despite not being so great in, let's say, in being profitable on operational activities. Because as you see here, the return on investment, so how much profit you make by using asset is in the order of 5, on average is 5% on these 3 here. So you see this is the total value of assets in $1,000, and this is the profit of each year. It's always positive, but if you make the ratio between the two, you obtain this value. In this case here you have a weird value because this company doesn't have interest on debt versus bank, so it doesn't borrow money from banks, so you don't have cost of debt. So it makes sense that is not available because you have just interest on investment. So you're just paying, you're just receiving some interest from investment that you have made, like for example borrowing money to other company. And you see, this is weird because, and I can explain you that because this company has a lot of short-term debts. So on short-term debts, usually you don't have to pay long-term interest because despite it doesn't have interest on debts versus bank in the long term, the structure of the debt versus equity is balanced in favor of debt. So in reality, this company is a lot balanced to acquire capital or to let's say to rely on external investment instead of equity. Again, because this is a particular company which tends to make a very short debit, and also has a lot of days payable referring to the supplier. So it has a lot of days payable outstanding for the supplier. While instead, if you see here, the profitability is very good. The return on sales is 20%, 22, 16. It means that you see on this amount of revenues, you are able to keep this level of profit, which means 20% of revenues, 22% of revenues, 60% of revenue, which is a very good, good performance. Yes, sorry, this is not correct. I just realized that it is not percent, but it is wrong. Sorry for that, I will correct this. But again, if you make the ratio between 12 and 47, you obtain 2.61. Here you obtain 3.2, which means that for realizing for realizing, no, that is correct. Sorry. I'm just realizing that it's just the percentage that is not good. It means that you don't have to use all the resources that you have because you have huge assets. Finally, if you see at activity rotation, you can see that total assets are higher than the revenues. So it makes sense that value are lower than 1. In each year, you just need to use part of your assets to obtain this type of revenues. In this case, for realizing $12,000 of which is 12 million of revenues, you need to use 0.26 of your total assets, value of total asset, which is 48 million. Then liquidity analysis instead look at the level of liquidity of the supplier during time, and these are the indicators that you can use to evaluate liquidity of the supplier. In particular, you have what is called the current ratio, which analyzes how much the balance sheet structure is balanced between current assets and liabilities. So it means making the ratio between current assets and current liabilities. You go back here, current liabilities, current assets. You make the ratio and you are able to understand if the suppliers is able to cover current liabilities with current assets. Current assets are assets that can be made liquid in the short term. Okay, so can be transformed in cash in the short term. So this means that if this value is higher than 1, it means that, of course, the supplier is able to cover current liabilities. So whenever some stakeholder claims right on the supplier, is able to cover this right with current assets. Acid test instead is the same of the current ratio. Just correct the current assets by saying that inventory can barely transform in cash in the short term. So on the current assets, everything can be transformed in cash besides inventory. So it just correct the fact that this ratio is more precise if we subtract from the current assets the inventory, and we're able to understand effectively how much the supplier is able to cover current liabilities with current assets. The elasticity index instead, sorry, here there are a lot of typos, I will fix them. This is current and also here, but anyway, this instead elasticity measure how much on the total assets are current assets. So how many of the supplier assets can be liquidated in the short term? Because again, current assets are all the assets that can be liquidated in the short term. So if it is 30%, it means that on the total assets, 30% are current. So can generate cash in this current year. While instead rigidity is the contrary. Rigidity is how much of the total assets are fixed. So how much of the total assets should expect to be kept after this year, and so not generating any cash cash in during this year. Here instead liquidity. So how many supplier assets are already liquid? So are already money, cash money, cash. So how much money I have in cash? There is a cash in the balance sheet. If you look at the asset with the cash, then you have sales outstanding. So these are all the revenue that I have generated on the market, which still need to be paid by the customer. Again, these are not physical cash right now, but they will be after the day sales outstanding will pass. So cash plus sales outstanding realize how much today is the amount of liquidity on the supplier side and how much they have incidence on the total assets. While instead, if I want to look at the liabilities, I can see the incidence of the short-term debt on total liabilities and the incidence of long-term debt in total liabilities. So it means analyzing from the current assets how much is the amount of short-term debits, for example, versus bank, and how much is long-term debits referring to example for bank with bank and making the ratio with total liabilities. This allows to assess how much the supplier has short-term debits and how much the supplier has long-term debits. Again, this is an example of calculation. So current assets here are 47 million and total liabilities, current liabilities are 44. So it means that the current ratio is 1.06. So in all the year, the supplier has higher current assets than current liabilities. So it's able to face possible claim of liabilities by stakeholder with current assets. This is still valid with the asset test because you can see the difference is very poor. So inventory has no incidence on supplier asset. Elasticity index. You see that this supplier has a lot of flexibility because 90% of the total asset are current assets, and you can see here, while just 1%, and this is typical of all the years, and most of them, very few, there is a low incidence of fixed asset. I have the reason of this. It is a service supplier, so it is not a manufacturing company. It is a service supplier. So it means that most of the assets that is owned are not property, machinery, plant, and inventory, but are just current assets. Liquidity index is 98%. So as you can see, much of the assets, and you see here, much of the assets that the supplier own are liquid. So cash and days payable outstanding, and are 98, 94, and 90% of the total assets. And again, very poor long-term debit, so 3% of the total liability as long-term debit, while instead it is a supplier, of course it's the same of the previous one, is a supplier which relies a lot on short-term debit, which incidence on 93% of the liabilities. Of course, if you see here the total debt, so the total debt is 96% on average of the total liability. So among the all liabilities, debt, meaning short-term and long-term, is 96% of the total liability. So from this perspective, I don't know if you get it, but we see that the supplier is in a good economic and profitability and liquidity condition, because all these indicators are good and are not giving any signal of criticality from a customer perspective. I don't deep dive too much on that because we will do that in class, but we can avoid to do this analysis by ourselves by addressing an external provider. Like the most famous one, the most diffused one in all over the world is Dun and Bradstreet. So you can click here and walk and look at which type of product this company offers, but this is the most diffused provider in the world. And it relies report of companies in order to assess their economic, financial, and reputation and risk condition. And what we will do on the next class is to analyze one of the report to understand how we can evaluate how suppliers perform from economic, financial, and risk and reputation perspective by reading one of these reports. In particular, as we can see in each report, DNB calculates some index like the financial stress class, the credit score class, the viability score, and this is the description of this index, and the Paydex index on 3 months and 9 and 12 months, 3 months and 24 months, in order to assess again the financial, credit, and viability condition of the supplier and its payment condition. This is to assess the supplier from a risk, a financial risk perspective. Then, from a reputational perspective, the supplier, the DNB also summarize which are the public feelings that have interested the supplier on a certain amount of time. So from this, we can infer something about the reputation of the supplier. So record type can be bankruptcy proceedings, judgment, lien, suits, or UCCs. And then we will see that there is the tail list. And finally, we can also assess the economic position because DNB calculate some of the main economic indicators that we have analyzed some minutes ago, and again, given the value for this business, in this case, in the case of this report, they are unavailable, and comparing with the industry mean in order to understand if your supplier is in line with the industry mean or is overperforming or is underperforming.